I'm going to be showing you AgenaTrader software in some of my examples. And so I just want to give them a shout out because I appreciate also their interest in trader education. Now, we're adults here. Let's remember that trading financial instruments using contracts, stocks, or options is extremely risky. So only trade with money you can afford to place at risk. Now we're going to be talking about day trading and futures, which is one of the most riskiest forms of trading, and it is not suitable for everyone. Past results do not guarantee future results. Please consult a licensed professional prior to trading using real money. And paper trade to learn any new concepts. Paper trade regardless of your level of expertise. Okay, as Renee mentioned, she gave you a little bit about my background. I'm just going to blow through this a little bit. This is me, and that's my collection of about, I don't know, 500 orchids behind me. This is my trading room. This is what it looks like at the house. Okay. And before you do anything else, before you settle into what I'm going to teach you today, I'd like to suggest that you take a moment, go to the website, hitthemarktrading.com, and you can sign up for my free client email. I send this out in the morning. It takes me about an hour and a half to write it. It takes you about a minute, 2 minutes to read it. All it is I'm looking at the overnight news. I'm looking at the charts. It's kind of a prep for day trading, but yet it's also position traders can pick it up. Okay, and I dropped some trade stuff in there as well. You know, levels of support and resistance, different stuff like that. So I think you really enjoy it, and it's free. So I'll put that, let's see, I'll try to put this in the chat for you. Hit the mark trading.com and go to the contact page. Very good. Now, what I'm talking about today is going to be pretty intense. I have a class I'm giving September 19 to 21. If you're interested, that's on the website. It's total immersion. If you are a position trader, if you don't like day trading, we're doing a position trading course September 26th to the 28th. Again, this is all on the website for you. Now, I'm a firm believer that you need to become your own expert, okay? And that's what all these other educators are really telling you. Become your own expert. So like many, I provide a nightly update, and we always work from the right edge of the chart. We always are looking, no matter what we're doing, whether it's day trading or position trading, holding over a few days or weeks, we're looking at the charts in an all-encompassing point of view. We're looking at price action, price oscillator, and I like to look at linkage between markets. And the reason is because we're in the 21st century. This is not your daddy's market. This is not your granddaddy's market. Everything is controlled by the machines. All right, let's get on with our featured presentation. What is momentum trading? Momentum trading is the art of spotting a market ready to move, selecting a trade, entering the trade with confidence, a quiet confidence, and utilizing predetermined exit points. Momentum trading builds off a firm understanding of support and resistance along with known areas price is attracted toward moving. Now, I am specifically talking today about day trading, okay? Day trading. We're going to be talking about riding the wave rather than reacting to what might happen. Usually it's accompanied by a price oscillator. I'll show you what I use. I'm going to show you how to, an exact plan that you can immediately test. And it's the same thing we use for intraday and short-term trading or long-term trading. Now, determining trend. Intraday is going to use the daily chart for the big picture. That's really all we're concerned about. What's going on in the daily chart for the big picture for the day trader, okay? We're going to use a short-term chart for tactical entries. As a general rule, the more volatile the market, the smaller the time frame. So in the beginning, I tried I don't know, 3-minute chart, 5-minute chart, and, you know, build strategies around that. But then I got heavily involved in programming these strategies, and especially with some help from other traders, we put a group together, and it was just empirically proven over and over and over that activity-based charts beat the time-based charts for day trading, okay, for day trading. All right, we know that a market moves in 3 directions, up, down, and sideways. If the market is sideways, we are greatly challenged unless the range is large. It is therefore imperative to find moving markets. What this means is ES futures traders must expand their horizon at times to other futures showing movement, okay? Now, very simple what I'm talking about here. To identify a trend, we're going to bracket price with trend lines. We're going to look at a daily chart, intraday chart as well, and we understand this heavy technical concept that price is simply going to bang back and forth between the trend lines, okay? Just keep your trading simple. Now, as I show you these charts, some of the charts you're going to see, let me see if I can get my arrow here, my pen. You're going to see stuff like this. Let me see. Okay. And I don't want to really delve on this too much, but these are automatic, these are signals that are built into the program I'm working with on AgenaTrader. So if you're wondering what those are, I just want to clear that up. Now, we talk about a sideways channel. This is a daily chart, by the way. Listen, a position trader cannot trade this. It's too tough. Absolutely, too tough. Too tough. One of the things, here's it says Rhymes Shortmaster. When we see a cluster of our signals, wow, it's telling us the bias is down, the bias is down, the bias is down. And then of course, boom, we went down. But we're talking about day trading. So I just want to show you that by looking at the chart, we can immediately see, okay, I get it, the trend is down, right? And you would draw your line something like this, right? Something like this. And it is meaningful when the line is broken. What do we talk about? Price just goes up and down, banging between the lines. Here's a little clue for you. If you do start drawing these lines on the daily chart and you're a day trader, when you hit the top, chances are you're going to have a pretty good move after you've hit the top. And that's basic. Okay, now let me see if I can erase that. For day trading, we must have movement. What this chart is showing you is simple, just that we have movement. Okay, we've got movement. This is how the day trader makes money. If we're not seeing this kind of range, this kind of movement, I'm telling you, it's very, very difficult. And then you make mistakes. So when you're looking at a day trading chart, this is what you want to see. You want to see movement, okay? You want to see movement. By the way, I use range bars, okay? And what that means is that the bar travels at least 10 ticks before it prints, okay? It travels at least 10 ticks, and then it prints a bar, and then it'll travel. The next bar travels 10 ticks, it prints a bar. I like that. I like that a lot. If you want to use, and those are called range bars. If you want to use volume bars or tick bars, no problem. I'm just telling you what I like. And one of the reasons I like it because I can easily know when I put in my protective stop that they're all going to be about the same because I use a mechanical stop. Okay, so looking at trend lines, let me get this erased. We know that they can help spot trading channels, up, down, sideways, and I do like to use no-go rules. If you're in day trading, we expect movement, we expect momentum. I believe, now this is just me, I believe, generally speaking, $200 range or less should be avoided. What does that mean exactly? It means if you find out that you took a trade, you had a signal and it had no follow through, and then we just kind of bang around in a tight channel, block it up, put a rectangle around it or a couple lines, to visually you can see I should avoid that. I should avoid that, because all that's going to happen is you're going to get totally chewed up. And here's a great example in this chart. All right, just going to be just totally chewed up, just totally chewed up. So we just simply have to recognize it. Otherwise, just drawing the lines, it becomes meaningful if we are breaking out of the lines. Now, what I like about the lines is that we learn to identify probable areas price wants to touch over and over again. We can use an oscillator as a trigger point for entry, but a lot of times just watching the price action between the lines, quite frankly, is all we need. Now, oscillators are going to derive their power from price movement. So for this reason, we really have to have an understanding of the price chart. The oscillator then provides a trigger point for entry. Now here's what most traders look like when they're trying to figure out which oscillator to use. I don't know if you remember the story of the 6 blind men, and they were each touching a different part of the element and describing, and they were so sure what they were touching. Well, it's kind of like that with retail traders. You know, somebody says, "Oh, this MACD, this is just the greatest." You know, I got the market by the horn here. It's just the greatest. And someone else says, "No, it's RSI." Someone says, "No, percent R." Someone says, "Bollinger Bands." Someone else says, "I know what's going on here. I've got the most expensive proprietary indicator. Gee, if it costs a lot of money, it must work, right?" The guy in the back says, "Well, you can't beat that slow stochastics." Okay. Everyone's going to perceive things differently, right? Now, tons of oscillators exist. You know that. Tons of oscillators exist. Everyone has their personal favorites. If you are not a day trader, if you are waiting for market close and you're doing evaluation, heavy chart evaluation, you can use everything. And I did that. In the beginning, I used slow stochastics, MACD, Williams percent R, and RSI. And at present, I find that I can just use one indicator after many, many years of trading and my desire to simplify. So I use the commodity channel index, also called the CCI. And here's an important aspect I'd like you to take home with you, and that is, in a strong momentum market, all price oscillators work, and I'm telling you, everything works. You could throw any moving average cross combination, it's going to work. It's easy. In a tight range market, all price oscillators are going to lose their predictive value, and I mean all of them. So this is one more reason to monitor several markets looking for momentum. It really is. You might want to check out some charts from 2004, 2005, and half of 2006, because if markets for day trading ever get like that again, it's not the people that are day trading that are making money, not trading equity index futures. Okay, so just understand, in a tight range market, all price oscillators are going to lose their predictive value. Now, what about the CCI? Donald Lambert created this. I met Mr. Lambert. In a moving market, the CCI is shown to lead price. That's a big statement. Don't take my word for it. Check out John Murphy's opinion in his book, Technical Analysis of the Financial Markets. Now, Mr. Murphy, his book is required reading for people that want to become a chartered market technician. Here's a statement that caught my eye. Notice that the CCI turns before prices at each top and bottom. The default length is 20 days. Wow. We like to say that we're getting a day's advantage. Okay. Let's look at this. So the CCI starts turning down, price goes down. Starts turning up, price goes up. Here we are up here, and price goes up. Absolutely. Okay. Now, a momentum indicator. What's one of the downsides? If it's going to get you in early, it can get you in. It can get you out early. We understand that. So here we're getting a first little warning sign, but the momentum is just keep going. It's very strong momentum. Okay. Now, the CCI is a price oscillator. All you need to know is that we're comparing price with a simple moving average over a selected time span. Mr. Lambert suggested a 20 period. Others have modified his suggestion for intraday use using 14, 6, and 5 period CCI. How do you calculate it? Don't worry about it. These charting platforms have this done for you. You simply define the time period. I'm going to show you this calculation because I know there's engineering types in the audience, or doctors, and people that are, seeing is believing, but calculations are proof. You can look at this on your own time. What I'd like you to appreciate is we are visual traders, visual. The CCI is plotted on a histogram. 0 line represents major support and resistance. The 100 line, 150 line represents minor support and resistance. So let's just take a look at this real quick and just show you what I'm talking about. Don't worry, I'm going to show you some price charts. Here's the 0 line, major support and resistance. So if I'm below it, I got a downward bias. If I'm above it, I got an upward bias. The 100 line is minor support resistance, and 150, and we say we're in extremes at 200. And then again, if we are in a downtrend, we've got minor support and resistance at minus 100, minus 150, and at 200, we just say we're at extremes. Now, all I'm going to teach you today that you can immediately start trading, okay, immediately start testing, I should say, is the diagonal trendline break on the CCI. It's very powerful. I like to say auspicious. You start drawing the line from the plus or minus 150 line. Simple concept, okay? We're going to adjust the CCI to 14 because we're working with a faster time period, right? The intraday, we got to adjust down from the default 20 to 14. And remember, smaller time frames in moving markets with good range. I also used to pound the table about trading during the rush hour, the morning rush hour, but gosh, we've had a lot of really slow mornings this year, a lot of real slow mornings, okay? And then they make it up in the afternoon. Now this diagonal trendline break on the CCI is what I'm gonna delve into. There are 4 other CCI patterns I use and teach, along with other robust setups, filters, and nuances, but I don't have the time today to talk about that. I'd say, 50% of the trades are accomplished with this diagonal trendline break, okay? You can immediately, I don't care if you are a day trader or a position trader, you can start working with this and you're going to be impressed. So the key point to remember, draw your trend line starting at 150 or minus 150. Better trades are in markets showing momentum. Use the 14 CCI for intraday below 60 minutes. Okay, here we go. This is the 10 range bar chart for crude. All I want to show you is just, okay, diagonal trendline break. Okay, up we go. That's true. Here's diagonal trendline break. Up we go. Now look, that wasn't much. That wasn't much. Could that have been a loser? Could have been. Wouldn't it be great if everyone won 100% of the time? Life doesn't work like that, I'm sorry. Diagonal trend line break, absolutely. We met the rule, right? 150, diagonal trend line break, up we go. Sweet trade. Overnight action, congestion, I understand that. Diagonal trend line break, a lot of moves with those Europeans and Asians around 3, 4 o'clock, and that starts the move down. Notice that we box this up. So if you're a conservative trader, what do? You wait. You wait for the box to break. Okay, diagonal trend line break here, says go up. Okay, diagonal trend line break here, says go down. And down we go. That's the gist of it. I've got more to show you. Diagonal trend line break with the trend. You can use a confirmation price bar, which means you get a trigger. Do you want one more price bar to print? You can use a confirmation price bar unless your trend is super strong, and we have methods of identifying super strong. Counter trend trading only after you have mastered trend trading. There is a reason why they say the trend is your friend. Now, I want to show you protective stop rule. This is the best thing I've ever found. Intraday, if you're going to go long, place your stop below, this is initial stop, below the trigger price bar or the prior price bar to the trigger. Whoever is lower, so that means you're going to get a trigger. Is the previous price bar lower? Then use that as your protective stop. If you're going to go short, place the stop above the trigger price bar or the prior price bar to the trigger, whichever's higher, and just leave it alone. And I tell you, if you just practice that one thing, you're going to be amazed. You're going to be amazed. A lot of people, unfortunately, are trying to trade things like crude and gold with, I don't know, 6 tick stops. They just get smashed out to bone to bits. So you got to just look at the chart and say what makes sense. Now, when it comes to, and I'll show you the stops on a chart, when it comes to profit target and profit taking, this is a highly personal issue. I can show you, but everyone has their own demons in their mind when it comes to money. I'm sorry, but they do. So some people are going to get excited if they make 50 bucks. Some people get excited if they make 20 bucks. Some people are going to get bored unless they're making 100 bucks. Some people are going to bet the farm when they shouldn't. It's very difficult to institute a mechanical stop when you're a discretionary trader, right? So this is why people blow out. The majority of people blow out. If we can have a mechanical system to keep us on track, and that's one reason I like that Agena software. If we have a mechanical system that's semi-automatic, then the trading becomes a little easier, so to speak. It becomes less stress because you've proven your system. You've proven the kind of stop you need, and so you put the trade on and you just relax. Today, I mentioned in the we've got a real-time room, and I mentioned when I first learned, my mentor told me, put the trade on, you've got your stop, you've got your target, and now leave the room. You've done everything right. If it's too difficult to watch the action because nothing is happening, leave the room. Believe it or not, that helps. Okay, if you're going to use profit targets, you decide what that is. Maybe, for example, in Q, we go for 15 ticks and 30 ticks. However, is the market giving you that? Do you need to back that off? Are we just slow and grinding? Should you even be trading that day? Maybe you ought to, you know, I go for 15 and we hit 14 the other day and I end up taking a loss. But anybody in the room that was going for 10 or 12 or 13 or 5 winners. So what does that tell us? That the secret is not winning big in day trading. The secret is winning small and winning often, stringing together a series of short duration, high profitable trades. All right, so you can decide the target. You can use CCI if it's starting to turn at the 150 line, turn back towards 0. It's telling you, hey, momentum might be weakening here. CCI crossed the 100 line, you should probably be out by then. If you touch a channel line, you know price bangs to topple and bangs to the bottom. Let's look at this. Now, here's 10 range bar chart. And here's diagonal trend line break. Here's entry. Perfect, right? So where's the stop? This is important. I said put your stop either at the low of the trigger bar or the previous bar, whoever is lower. So that means stop goes here, just below the bar. What does that mean? A couple ticks, 3 ticks. That's it. That's initial stop. And wonderful how that works. Here is another trade. You might have been taking profits and got a runner going. I don't know. I don't know what your style is. Here's another one. Here's the trigger. Who's lower? This guy. Put the stop there. So you're in that trade. Doesn't go much. And if you waited, I guess you're knocked out probably either here or here. Okay? Knocked out. It happens. Here's a trade. Here's the trigger. Here's the trailing stop. I'm sorry, the initial protective stop right here. Remember, who's lower, the trigger bar or the bar previous? If you test this out, you're going to be amazed. Okay? Now, you can see, yes, I got a signal here. Got a signal here, didn't work. Got a signal here, didn't do much, but it did go in the intended direction. And then we break out. And this is what we live for. Now the trailing stop is something we call the rhyme stop. It's something only in the AgenaTrader. But what it is it's a stop that I've worked with using volatility. And other people have their different ideas on how they want to trail their position. Again, if some people are just working for profit targets, maybe they're just, I've seen people just a bar print and they just raise it up every time they print a new green bar. You are the trader in command. Okay, now this is overnight, so naturally in the overnight we're going to get this kind of action. We know that. Okay, we know that. I think you should block it up and wait for it to break out of the box, which is exactly what was happening here. The signal from the CCI actually got in a little bit better. Where's the stop? Who is higher? The stop is here. And of course, what a marvelous run. You can immediately start testing this. Okay. All right, diagonal trend line break, and whoa, there's our signal there too. Where's the stop? Who's higher? This guy. And the red line is just your protective stop. He won't be activated unless price, you don't touch it, but actually has to close above it, and then he takes you out. Okay. Now look, it's your first exposure to this. I don't expect you to get all of this. You're going to have to watch this recording again, and that's fine. Crude day trading. Now this is yesterday when I put these slides together. Okay, first off, okay, well, that didn't do much, but look at this. Wow, quite nice, right? Beautiful. I like it. I like it. I like it. What? Okay, what's going on here? Tight sideways. But we have a cluster of signals and they're all saying short. So I immediately have a bias and I'm being told, wait for the breakdown. That's how that works. That's crude. I switch to 15. I normally am looking at a 10 and a 20, watching the 20, taking the trades off of a 10. Okay, but the system is good enough for any time frame. Here's the 10 range. Why do we vary the range? Is probably a good question. Because if we're not getting much movement, then we open it up to a wider range and let price prove it really wants to move. Normally, the 10 range bar euro is all we're using. Here's a beautiful trade. Look at this. Okay. Okay, here's a nice cluster. That gives me a downward bias, and by golly, we went lower. Here's one. He's saying I may not get in at the bottom because it could just go sideways, but when the coast is clear, I go. Nice. Okay. Beautiful. All right. Here's the same chart with the, let me move this, with the trailing stop. Okay. Remember, it's not going to get triggered unless price closes below it. Just beautiful. Beautiful, beautiful, beautiful. Now, this is available through AgenaTrader. This is buying the whole package. There's also a rent to buy, which is a lot cheaper for a short duration if that's what you want to do. Otherwise, the cheaper alternative is to pay for the entire add-on. So you can go to AgenaTrader.com, or you can go to my website under resources. There's a link. But otherwise, AgenaTrader.com, and go to the store. And there's rent to buy right there. So you can rent it for whatever time frame you want. Now, the reason I like the AgenaTrader, it's a semi-automated trading environment. So a signal's generated, automatically there is a protective stop, there's targets, and the trailing stop. It's all there. You load it, whatever your strategy is, you load it. If you're going to use my strategy, great. You see your suggested signal on the chart, the protective stop, trailing stop. It's like go. You even have built-in money management for order sizing, okay? So you quickly agree or not, and because at all times, you are the trader in command. This is not automated. This is semi-automated. You make the decision. Your assistant says, I have something you might be interested in. All right. Let's see here. Everything I mentioned is robust across any instrument, across any chart time frame. If an action repeats, we can trade it. And remember, day trading charts use activity-based rather than time charts. The reason I don't like time charts, in a 3-minute period or 5-minute period, you might get a giant price bar, and then you enter the trade. It does a normal pullback, knock you out, and then it goes on its merry way. Remember no-go rules. I'm not interested in taking a trade if the range is around $200. I must let price resolve the issue. Okay? Oscillators are going to be moving around and they're going to chop you up. So you let price resolve the chop. I think I'm getting really close to my time here now. Remember that day trading is best suited for visual traders who can react with quiet confidence, knowing losses are part of the game. Use clean charts for faster decisions. A day trader is no different than a professional poker player. It's not each hand. It is a series of hands, a series of trades which determines the outcome. That is a very big, close analogy there. Okay, don't beat yourself up if you lose one trade or two trades or the whole day's a loss. It's not about that day. It's a numbers game. You get in and you get out taking a series of trades rather than pinning your hopes on a huge trade of the century. Your ego makes you look for the trade of the day. And experienced traders know that we are more like, in day trading, a mouse under the banquet table looking for crumbs during the intraday trading noise. Okay? I like to look at a system really over 3 months. All day traders are going to experience drawdown if markets are simply not moving. That's why in the summer I hardly trade Monday or Friday. It's just not for me. Of course, last Friday was wonderful. I missed it. That's fine. Most people fail at day trading because they forget about thinking like an elephant. An elephant gets mighty big eating peanuts. And the day trader capturing a series of trades and then leaving the game, waiting for the next trade, is happy even if they miss the trade of the century. All right, so that's all for me today. I'll take questions. Thanks to our host for the webinar. Thanks to Renee and Market Traders Institute. I appreciate the charts from AgenaTrader. Remember, you can sign up for free access to Rooster Call. Hit themarktrading.com. Why not? Why not? I am holding a in-depth 6 hours class on September 19 through the 21. You don't want to wait that long, I understand. You can very easily buy the recordings from my last class, and you're all prepared to come to class on September 19 and 20. All right, that's it for me. Let me look at my questions, and Renee, just tell me when I need to stop talking here. Let's see here. I don't think I see the questions.
You should be able to see them on your control panel under questions. There's a little arrow that you can click to pop it out so you can see them more. If not, I can read some to you as well.
Okay, let's see here. I'm getting some of the others. Can the speaker explain how to draw a diagonal trend line for this E-minis? Okay, sure. Wonderful. Good question, by the way. Okay. Here's what I like to do. I'm going to draw it from this, remember, the 150 line. And what I want to have is I want to have this at least touch the CCI somewhere. Okay, so there it touches it. So that's rough. Now, this is counter trend because remember, I'm down here below the 0 line, and that gives me a downward bias, so I realize it's counter trend. Shouldn't I be taking a trend trade? Well, then what would I do? Well, here's the 150, minus 150 line, okay? So I got a bump here, so I'm going to draw it like this, and that's a short, so that's about where, right here, something like that. I don't know, maybe it's here. The bump represents like the CCI tried to go through, couldn't come up, and then finally breaks down. Here's another one. Here's a bump. Run it up, and that's a short. Okay, somewhere along in here. I'm not the best drawer. Let's see now. We have notice how on this Agena chart, I've got the yellow line says, okay, now we want to be looking for an upward movement, an upward bias. That's what that means. And we're now ready for an upward bias. Over here, the yellow says we're now ready for a downward bias. Okay. Blue says bias is up. Okay, so that means that this is a counter trend trade here, right? It's counter trend trade. Trend is your friend. Here's a diagonal trend line break here. No bump, just straight down. Here's another one where I do have a bump. And this, I guess, is about right here. Here's a beautiful one here. Here's from 150. I got a bump. I'm sorry, I'm not good at drawing these lines. But there's my diagonal trend line break, and of course there's our arrow. Take the trade. This worked, but it's not from 150. What's the problem? It worked. Why don't, what's the problem? Well, it's not from 150. I always want new people to start drawing from 150 because as a general rule, you have greater follow through if you can draw it from 150. If you know and work with one single instrument or just two, and you know them like the back of your hand, then sure, you can test drawing them from the 100 line. The other thing is, if you know how to measure the strength of the movement of the momentum, if you know how to measure that, then you can become more aggressive. Absolutely. So I hope that helped. I hope that helped. Here's that cluster. When it shows up, it's a pretty good signal. It's like saying, uh-oh, we're going to go lower. There's our bias, and by golly, we got 3 clusters, or 3 of these, and that was a good move. Okay, let me just go back to this. Can you use on Forex? Absolutely. Can we try the software out in Sim? You can. They'll give you, I think, a 30-day. Cannot find Rooster call on site. It's on there. Got to go to. It's on there. Go to the services page or the contact page. You sign up on the contact page.